One more reform proposal, and there's a lot that we could do, but for the sake of time, just one more I'm going to throw out there, and then we'll move to lessons learned from the inflation surge. And this is a proposal I've heard from many people, and it deals with the fact that the Fed has so many responsibilities, and one of them is regulating banks, being a bank supervisor. In fact, probably the most important one. Is that fair? The most important bank regulator in the
I think
U.S.
so.
Okay.
Yeah.
Okay.
Yeah.
So one of the concerns is, it's one thing to have like budgetary independence when you're doing monetary policy. You're not dependent upon Congress to, to fund your operations because it might get politicized. But some people worry, when you're the bank regulator, maybe it is useful to go get appropriations for Congress. The FDIC, control of the currency, they all, are subject to this democratic accountability because when you start doing those issues tend to be more fiscal, more there's issues at stake that aren't necessarily at stake with monetary policy. So there's been some calls to at least take some of the bank regulatory responsibilities out of the Fed, maybe move them to another agency. And there's been different forms of this, but what is your sense of that? Is that practical? Is it a good idea?
When I look at proposals like that, I think the core issue is the discount window. If the Fed's going to be a lender to these institutions, it needs some insight. It needs some ongoing monitoring. So think of the discount window as a line of credit, and think about a private commercial bank entering into a line of credit arrangement with some company, some client, a borrower. So they get a lot of financial information up front. There's covenants in the line of credit that require the borrower to file financial statements. There's other covenants that tell the borrower they have to meet certain financial ratios, a certain amount of liquidity, a certain amount of capital. They can't borrow too much. They have to get permission to borrow more. All sorts of things that kind of align incentives, control the risk. And then at the end of the day, there's a material adverse change clause that says, all right, you have a line of credit with us that says you can, at your discretion, borrow at this rate, a spread above some, market rate. But if there's a material adverse change in your condition, not covered by any of these covenants, we can pull the line. We can deny that credit. So in comparison, the Fed doesn't look too good. And to weaken its hand by making it jump to another agency for the information. I mean, I've seen how that works in cases in which troubled institutions, are looking for credit. To have to go to another, for the Fed to have to go to the FDIC or the comptroller or the currency for information, or some other agency for information about potential borrowers, it's problematic at times, and you get you get into kind of turf considerations and misalignment of the agency's incentives. So to me, evaluating those proposals depends on, well, what do you do with the discount window?
Okay.
Now, some have said you could shut it down.
Really?
Anna Schwartz, for example, in 1992 said it's outlived its usefulness.
Would she not have it moved somewhere else, or it would just completely shut down?
They can borrow from another bank if they want.
Okay.
Let them go to the market.
So I don't think that's ever going to happen.
I don't think so either. But
so that's a very compelling counterpoint, that if you're going to do the discount window, you need to be able to know who you're lending to, and if they're got good credit, good collateral, will they behave themselves?
Yep.
Kind of avoid some of the risk. Okay, so good point, fair point.